Hey everyone, what's up? And welcome to Front Run Crypto, where we predict the future of money and technology. Thank you to all of the new listeners, followers, and subscribers. Your feedback is super appreciated. If you are new to Front Run, or if this is your first time with us, we are all here to front run what we believe is the next generation of wealth creation, and that is cryptocurrency and decentralized finance. Even in the middle of this bear market, even all the uncertainty that we're experiencing with the FTX fallout, 80% drawdowns, Bitcoin, crypto, Ethereum, it all has the potential to be a transformative technology, right? Ethereum can be the settlement layer for all major financial transaction. Bitcoin could even go as far as representing a potential new like monetary policy, one that's not beholden. Is defined within smart contracts. Wow, what a crazy idea. I'm your host, John Cook, and it is Saturday, December 10th, 2022. This is Crypto Before Bed. It's a 30 to 45 minute ish highlight of all of the day's major crypto events. I've decided to launch Crypto Before Bed because I found that so much news happens throughout the day that if you were to wait until the end of the week to try to do one massive update, it would just be like a 4 hour long podcast, right? And that's not really the thesis of Front Run, right? We are not a news publication. Front Run has one goal, and that is to help you participate in the next generation of wealth creation. And we do this by writing hands-on tutorials, providing long-form analysis about the state of the market. We just published many guides, cover a couple just as a plug so you can all see the breadth that we're talking about. We recently posted how Grayscale's Bitcoin Premium was a leveraged Ponzi, how FTX engineered a fake bailout of BlockFi, how S&P 500 the S&P 500 forecast for calendar year 2023. I've posed my prediction. We compared it against the major banks of 2022 and how they got it all wrong, how they're forecasting it in 2023. It goes on and on and on. These the long form detailed analyses are available at frontruncrypto.com. This podcast is just on YouTube that we're going to stream live now. Try something new. Is a mechanism to just say, hey, here's what happened in the crypto ecosystem that you should be aware of. So, for those who haven't, make sure you check out frontruncrypto.com because one of the really like impactful feedback items I got is let's make sure we lead with like the hands-on part. Right. How do you build competency in anything, whether it's DeFi or in life? My philosophy, right, after a decade in finance, technology, Silicon Valley, is by doing. So if you go to the About section of frontruncrypto.com, you'll see that we've actually moved our top four hands-on guides to the very top. So if you're new to decentralized finance or crypto in general, I encourage you to take a moment to actually go through these four guides. They're very in depth, and I promise you, if you stick through it, you're gonna know 90%. You're gonna know more than like 90% of like the majority of crypto experts out there. Part one, it outlines how to transact on Ethereum, but it's really a deep dive on how to understand and calculate gas fees. Like, what does it mean to have a gas fee? What are the composition of items that make up a gas fee that goes to the staker that gets burnt, right? How do you calculate GUE? You're going to be a gas fee calculation master by the end of part one. Part two outlines like what it means to have a layer two roll up, the types of layer two roll ups, and the difference in gas fees. Part three is really a crash course on lending, and how to measure risk, right? Risk is a very quantifiable point of view in decentralized finance. And part four is an add on to that, where we actually cover the mechanics of repaying a loan, preventing automatic liquidation, and we quantify something called a liquidation threshold. So if all of or any of those sound unfamiliar to you, I would actually stop all the crypto stuff you're doing and make sure you complete that first, because if you don't know like what automatic liquidations are, how to calculate a liquidation threshold, right? How do you measure risk in an asset? You probably shouldn't be investing in crypto. Okay, and all that's free, of course. So with that said, today in bedtime before bed, we're going to cover some interesting topics that continue. It's like old is new, and we just deja vu every day, right? Centralized NFT metadata, it's gone. Specifically, the FTX.US exchange. When are we going to learn? We'll cover the state of the crypto thread by the folks at Masari, and just the hypocrisy and like their point of view on like innovation with like more centralized pre-mined tokens that don't adhere to the values of crypto. We'll talk about the Block and SBF and how SBF basically bought and sold them. We called this out in our post-mainstream mediocrity, but this just is an affirmation to me that you have to be really careful with any mainstream media publication in traditional media as well as crypto, right? Remember, CoinDesk is owned by DCG, which has a interest. I mean, well, back up. DCG owns Genesis and Grayscale, right? So if CoinDesk is going to do any comprehensive reporting on Genesis or Grayscale, which is the trust that holds Bitcoin, you got to ask yourself, are they really going to do it, right? And are they going to do it objectively? My answer is no. And you've already seen this been proven with the block. We'll also cover Bitcoin's capital reset. This is this concept where Bitcoin losses are converging on the spot price of Bitcoin, thereby creating a potential bottom. And we'll wrap up with some positive news that staked Ethereum might have a release date, right? For those who aren't sure, staked Ethereum is one way in right now. You take 32 ETH, you become a staker, you earn yield by verifying blocks on the Ethereum blockchain. And the problem is that the ETH can't be released until the Ethereum Foundation deploys an update, which is now has a tentative target date. So we'll cover that very briefly. That's major news. And then we'll discuss like the potential downward pressure that it could have on the Ethereum market. So let's start with the centralized NFT fiasco. The folks at Bankless published an article. You can see this is actually all over the Twitterverse, but they summarized it pretty nicely. And I'll quote them. Some popular NFT platforms from the 2017-2018 era, like Ascribe, Digital Objects, and Additional, eventually went under. Right? Lost NFTs are nothing new. These early losses later spurred lots of advances around decentralized storage networks, as well as totally on-chain NFTs whose metadata are forever retrievable on the blockchain. That's the key words, forever retrievable on the blockchain, right? This is only possible on completely decentralized storage networks. What are some decentralized storage networks you should know? Well, if you go to our FrontRun site, frontrun.notion.site, you'll actually see we have a wiki there, and the wiki outlines all the major DeFi storage providers. I'll pull it up for y'all so you can see it really quick. Airweave, Radical is infrastructure. This is a game changer, man. So like think of like a GitHub that's completely decentralized, right? There's also, of course, DSO, IPFS. Those are really the big ones. There's some like unique spot providers like Pinata and NFT Storage. Check those out too. But the point is that these are all Web3 storage facilities where, unlike Web2, the metadata, which is the graphics, if it's a JPEG, are stored on a decentralized peer-to-peer network of computers, not in one data center on AWS Cloud or Amazon or Azure Cloud, right? So that is the future that we should all aspire to. But per Bankless, not everyone pays attention to the lessons of the crypto industry. For example, consider SBF of FTX. This is what his first NFT minted on FTX looked like circa 2021. For those listening on podcasts, not on YouTube, I'm displaying a picture of an NFT with the word test. It says test. That's it. TEST was written in paint. It sold for $270,000 USD. There's a point of view that this might actually be money laundering. We could set that aside for sure. But what we're conveying here is that all of the NFTs bought on the FTX.US exchange, the metadata is gone, right? It's gone. Why? Because it was hosted on a centralized provider. So Jacob.Soul tweeted out, "Oh look, FTX hosted all the NFTs minted on their platform using a Web2 API, and now all of those NFTs have broken metadata, and the links go to the restructuring website." And what you'll actually see if you click his tweet is a picture of the JSON object that references the image, the URL actually, that now goes to the FTX website, which is now redirected to the bankruptcy proceedings page. Oh, this isn't loading. Let's see if we can get this up. Cool. We'll zoom in a little bit more. Let's see if we can zoom in. So you can see here, this is the JSON object. Look at the URI. It says string https ftx.us. This is a problem. This is a problem because it's a centralized Web2 provider. It's probably Azure or AWS. So I want to sidebar very briefly and show all you guys how you can do this for your NFT, because you really should. If you have an NFT on a centralized exchange, like OpenSea will tell you this, but you should know like what your plan Bs are. So for example, I went to OpenSea, I bought an NFT for funsies. You can see in the details that the metadata is centralized, but you got to know, like, what does it actually mean? All right, so you can go to the contract address on the blockchain explorer for that particular NFT. In this case, um, let's see, this is Polyscan. All right, so it's do this live. Okay, Polyscan contract, read contract. And what you can see is if you go down to the attributes of the contract, you'll see something called, I think it's template URI. Yeah, template URI is the open API for OpenSea. So when you call this endpoint and you pass in the token ID of your NFT, it's going to return the JSON object that that outlines where your metadata is stored. So I'm going to copy the token ID. Did I copy it? I copied it. I'm going to paste it into the as a parameter to the OpenSea endpoint. And you can see here's the asset token JSON object right here. And look, here's the but when you click the link, it takes you to the actual JPEG of the NFT, which in this case is a cat, right? So you should do this. Make sure you understand, like, hey, my NFT is fully centralized, sufficiently decentralized, or something in between. And if it's centralized, you got to at least download the metadata, but it's probably not good enough in the long run, especially if you embrace the philosophies of decentralized finance and DeFi storage. You should only purchase NFTs where the metadata is sufficiently decentralized, and that the easiest way to like think about that is to make sure you have a storage provider like probably IPFS is the most popular one. So moving on, not to be FTX, not to be undone. Ryan Selkis from Masari, guy's insane. He posted a tweet thread that kind of summarizes his point of view on the state of crypto. Okay. Well, I'll read it, then we can go through it together. It says, bad week, bad month, bad year, especially for the overlevered, greedy, and ethical. All right. The long-term builders have been hurt by association, but they aren't the ones who have been perpetuating fraud or fleecing investors. Remember that sentence. They aren't the ones perpetuating fraud or fleecing investors. So he goes on to say, opaque lenders, C5 bucket shops, low float tokens like FTT, no diligence VCs, paid personalities, all dead, good riddance. So then he goes on to say, who are the innovators? And to my surprise, this guy actually calls out Solana and Sui. Aptos and Sui. Aptos and Sui are pre-mined layer ones that are competing with Ethereum. They literally have billions of dollars of VC money behind it. I think SWI is a derivative of the and the whole point of this is that the statement made was innovators remain, VCs are dead, the shills are gone. But look at the freaking Aptos Foundation, right? The Aptos Foundation, which holds the APT token, it was all pre-mined from CoinDesk. The initial token supply of Aptos tokens at Monday's mainnet launch was 1 billion, with some 510 million committed to distributed to community members, 190 million to core developers, and the remaining to Apto Foundation and private investors. So the Aptos Foundation holds like 50%, 50% that will be released over the next 10 years. And you got to call out this like 510 million distributed to community members. It's pro rata discretion of Aptos, right? And here's the crazy part. Here's uh, the token supply curve over the next 10 years. And you can see like the play out between, for those listening, it's the x-axis is time and the y-axis is total circulating supply. It goes up, right? And you can see it looks so misleading because you see like multiple colors. So you're like, oh, that's appropriately distributed amongst a wide variety of stakeholders, but it's not, right? Found like the foundation, the investors, the core contributors, the community. That's all the same people, man. It's all the same people, right? It's such a hack, and it only gets worse. I saw this Aptos blockchain. Saw this come up yesterday, or maybe it was the day before. Blockchain startup Aptos Labs settles $1 billion investor lawsuit. And the gist of this is that Aptos Labs settled a lawsuit with LA entrepreneur. Ooh, the hell? With an LA entrepreneur who claimed that his asset dropped 50% because it did, right? If we go to CoinDesk, we could follow on. Aptos debuts its blockchain, putting millions in VCs to the tests, right? Oh, Aptos is the brainchild behind several ex-Meta employees who failed the DM stablecoin, right? Aptos secured 200 million in funding led by A16Z. Series A led by FTX Ventures and Jump Crypto, right? The second round reported the valuation at $2 billion, 4 times higher than the company's previous rounds. So what happened is when this launched, when testnet launched, right, the VCs, at least some of the VCs dumped their coin onto the retail traders. I wonder if we can see Aptos on trading desk. Let's see Aptos USD. I'm gonna pull this up really quick. Aptos US dollar Coinbase. And you can see if we just go to zoom out to all, unbelievable, dude. It dropped like 50%, 50% from its peak. I bet no revenue accrues to the Aptos token. So Ryan Selkis, I think you got it wrong, dude. And what's crazy is Masari is a really good platform that I use to like research like tokenomics. It's very important. Like for example, you can go to Masari, you can type in Ethereum, and you can actually see the token supply schedule, right? You can go to profile, and then token economics, and then it outlines like the initial launch and token allocation and like the distribution, right? And the actual supply schedule, which you can see here, is it's pretty flat. Even the same thing for FTT. But when you type in Aptos, it doesn't actually have it, which is wild because even on completely pre-mined NF pre-mined layer ones, you'll still see the analytics. Like it's not there. I don't know if it's intentional, but like, dude, that is an odd look. It only shows a circulating supply, 130 million tokens, dude. But even for FTT, you can look at the FTX token, and you can see metrics, and you can see the supply schedule for the FTT token. Right? It's all there. Something's fishy. We can reject this. At this point within the DeFi landscape, I'm quite apprehensive against any layer one where the majority of the tokens are pre-mined, granted to investors, and then dumped on the retail public at some point in the future. It's generally doesn't adhere to like the philosophies of decentralized finance. But another thing that doesn't adhere to DeFi is SBF, right? On the Twitterverse, exclusive, SBF secretly funded crypto news site The Block for over a year with money funneled to the Block CEO from the disgrace Sam Bankman-Fried cryptocurrency. Just when you think it couldn't get any worse, it gets worse. And I'm so over like reporting on SBF and FTX, but I just got to call this out. Like maybe a month ago, we wrote an article on just it was called Mainstream Mediocrity, and it's how corporate media and even certain news articles or news publishers within the crypto system are really bought and sold by money, right? Within the Mainstream Mediocrity article, I outline like a bunch of different publications that just like they just completely missed the mark. And at the very freaking top, we have The Block. On the left hand side, they posted like an article about the Alameda CEO and how they frame her as like a savant. And then this clearly got a lot of heat, Twitterverse backlash for sure, because it doesn't outline any of her follies or participation. So the publisher like went and backtracked the headline to try to make it a little more objective and not an attempt to like cast her in such a favorable light. This is The Block. So with that in mind, is it any freaking surprise that like the Block CEO is accepting money from SBF, who's funneling it from FTX? Let's read the article together. The payments, which employees of the Block were previously unaware of, could undermine the news company's credibility and cast doubt on its coverage of SBF, who the now bankrupt FTX and Alameda Research oversee Bankman's trading firm. 116 million batch of funding from Alameda was used in part to finance the purchase of an apartment in the Bahamas for the Block CEO. Unbelievable. The Block CEO resigned and is leaving the company. The Block This is why if there's ever a scenario where are there any conflicts of interest that are preventing this person from objectively reporting the truth, right? This could be in the form of a sponsorship. It could be in the form of like a YouTuber trying to push or shield their coin. But you got to be super careful, man, and always do your own due diligence. Like if there's a publication that you read, I encourage you to actually look at its disclosures and see like what it's where its financial interests lie. That will ultimately determine the type of reporting the publication does or does not do. So the Block, RIP, we're never going to read them again. They're also beholden to the billionaire class. Now, One important topic that we have to cover, and I'm going to keep pressing this. We talked about this last week and the week before. We're going to talk about it again. It's fundamentals of tokens, right? Specifically, we're going to focus on, let's see if we can pull this up, lending protocols on Ethereum. So token $1 billion over the past year. The collapse of UST and Luna was particularly hard hitting for the DeFi lending market, with total volume across major lending protocols dropping from 22 billion to 14 billion. This is denominated in US dollars, right? So it's actually saying that the volume of currency traded across all platforms, lending protocols, over the past really since May 2022, dropped from $22 billion to $14 billion in 2 weeks, and is now at $8 billion, right? So that's one aspect to consider. The impact of major black swan events like the UST Luna collapse, for sure. But the point we're emphasizing here is, what is the role that that lending platforms with incentive tokens have on the long-term viability of the lending platform, right? This means it's a marketing expense. Tokens are being given to participants who use like Aave on Arbitrum as an incentive to use Aave on Arbitrum, and not like lend or borrow on Compound, right? As an example. Lending protocols that give out the most token incentives typically also have the most successful launches when measured by volume, right? But this comes at the cost of negative token earnings, right? This means the tokens are inflationary. Optimism is an inflationary token, right? This trend remains true for lending protocols regardless of the date of their launch, which may be in drastically different stages of the market cycle. Using Aave as an example, Aave's borrowing volume and optimism dissipated after the OP token incentive ran out, right? So look, this this is like crazy. There's two parts to this chart for those who are listening on. But borrowing volume June 2022 was like $6 billion on Aave across all chains: Ethereum, Avalanche, Optimism, Polygon, right? But the Optimism liquidity mining program went live June 30th, 2022, right? This is the OP token given to users as an incentive to use Optimism to do DeFi stuff, right? And you can see when it launched on June 30th, 2022, what, 4 billion to 5, from 0 to a billion on Optimism. So 0 to a billion from July to August on Optimism, specifically looking at Aave's borrowing volume, right? But look what happens on November 6, 2022, when the incentive program ended. Aave's borrowing volume on Optimism decreased from 900 million to 5 million. $5 million in 1 week. So think about that. The Aave is on Optimism. Optimism initiates a liquidity mining program. Lending Utilization, which is the borrowing volume of Aave, like pretty much goes to zero, right? As of November 7th, as of 27th November 2022, Aave's borrowing volume and optimism remains only at $4 million, right? And just a reminder, guys, that there's another dimension that you can add on to this, and lending protocols with the largest borrowing volumes following their launch also tend to have negative earnings, right? So this is revenue minus earnings is negative, right? So that means no, that's borrowing cost minus earnings is negative. What did these guys say up here? Let's scroll through this really quick. Yeah, negative earnings. This is wrong. So incentives get paid out minus the revenue that's collected. The incentive payout is greater than the revenue. So what can we take away from this is if you're going to mine tokens on any type of lending platform, demand is probably, I would say it's synthetic. It's not real demand. On a it's based on yield. But let's move on. Let's move on to Bitcoin. The capital reset. Glassnode published a really good article. Y'all got to check it out. It basically outlines considerable consolidation above cycle lows following a few weeks in the wake of the FTX implosion. Price action has seen a strong recovery. And then they go on to explore the severity of losses experienced by market participants in what they called the largest deleveraging event in history. What I want to call out is the realized profit and loss, right? Realized price action continues to decline, severity of loss diminishes. What does that mean, right? So both the June 2022 sell-off, the FTX implosion, prompted investor capitulation events that are of a historical scale. The FTX event recorded an at the high one-day loss of negative $4 billion. However, assessed within a weekly moving average, loss appears to be subsiding. All right, June's sell-off by comparison sustained over negative $700 million in losses each day for almost 2 weeks, right? So the losses, wow. So the losses in the June sell-off were greater than the FTX implosion, right? Be 7 million times 14 times 10, 7 billion. So it's about 18, 19 billion that was lost, right? In the June sell-off, and FTX recorded a one-day loss of negative 4 billion, right? So what they go on to say is that the ratio between realized profit and realized loss. Realized profit is the difference between your acquisition price of the token and when you actually sell it. If your sell price is lower than your acquisition price, then it's a realized loss. Otherwise, it's a realized gain. Unrealized means you're negative, but you haven't sold it. So if you bought Bitcoin at 50,000 and it's trading at 18,000, you have an unrealized loss of maybe 30,000, but it's unrealized. You haven't sold it, right? So they go on to say the severity of losses is diminishing, right? So as the price goes down on Bitcoin, the severity of losses also decreases. I mean, and that makes sense. You have it's a combination of new participants as well as existing whales continuing to double down on Bitcoin, thereby adjusting their cost base to this at the new all-time low, really, over the past 2 years. So this indicates losses locked in the market were 14x larger than profit-taking events. It is likely this in part reflects how the entirety of the 2022 cycle price action is above the spot price. And then it goes on to outline the realized profit loss ratios over the 2011, 2015, 2018 cycle. And a really easy way to conceptualize this is that people who bought at the peak have the highest realized loss, but as new participants acquire more Bitcoin, it pushes down their realized loss because they're buying at a lower spot price, which decreases the 7-day moving average of the realized profit loss ratio. Some of these metrics are kind of wonky. Like I guess what I want to take away from this is that new participants as well as existing buyers are buying more Bitcoin at a lower spot price, which is reducing their cost basis. Last but not least, we can wrap this up. On Twitter, Ethereum developers target March 2023 for release of staked Ether. That's amazing, and this is like worthwhile for sure. Staked Ether withdrawals are coming, according to CoinDesk, while proto-dank sharding, which is a way to aggregate transactions, right, such that the Ethereum blockchain will have higher throughput. That will happen. Oh, in a following hard fork in the fall. Wow, so they're actually separating it out. So, according to CoinDesk, Ethereum developers determined on Thursday that the network's next hard fork, called Shanghai, will have a target release timeframe of March 2023. This upgrade will include EIP 4895, which will enable the beacon chain to withdraw ETH. Hmm. Hmm. This Then it goes on to talk about other like initiatives with upcoming EIP scheduled for hard forks in the fall, like EIP 4844, which is proto-dank sharding, that will split up again the networks into shards, which are like blobs, as a way to increase its capacity and bring down gas fees. I think although this is interesting, for sure appreciated, we have to call out that beacon chain push withdrawals as operations. How much of downward pressure will this cause on Ethereum, the token? So maybe we can look up staked ETH, Lido, Dune analytics, and we can see, I think, like 12 or 13% of the total staked ETH population. 12 or 13% of the total ETH population is staked. You can go into this Lido Finance Extended. Let's see, this one has like 384 subscribers. So we load up the Dune Analytics dashboard. I'm trying to figure out like what percentage of the total ETH population, ETH network is staked. ETH stake with Lido. You can zoom in here. Yeah, 4 million ETH staked. 4 million Lido ETH deposited. Yeah, ETH stake with Lido, 4 million ETH, 107,000 ETH depositors, Lido staking APR. ETH staked with Lido. So of the total, wow, Lido represents 30% of the total ETH stake population. That's pretty impressive, right? I think it's by far the single largest derivative staking provider on Ethereum. Yeah. So maybe it's 4 million, 4.5 million ETH. So as one way to think about this is um it's similar to proof of work actually. There will be like an inverse relationship between the number of staked ETH and the yield or APR of the stake ETH. As more participants deploy ETH to be staked, it pushes down the APR. As participants withdraw their ETH with this upcoming Shanghai upgrade, it will push up the APR. So you're going to end up having this equilibrium where market participants will be incentivized to stake ETH because they'll earn a higher yield. I don't actually think there's much of an incentive to stake ETH right now because it's only paying 4.5%. This is lower than the risk-free rate of return. 6-month treasury bills are paying 4%. That's backed by the US government. So there isn't much incentive for new participants to stake ETH. These are existing participants, probably from like 2017, 2018, when the beacon chain was first deployed. Staking ETH, waiting for the ETH to be unlocked via the next upgrade, which will ultimately cause participants to withdraw ETH, which will drive up the APR, which will push participants to deposit ETH, which will drive down the APR until there's an equilibrium. So this is not going to be in the world. It's going to be supply and demand dynamics that continue to permeate. Cool. So that's it. Lots of great content today. NFT metadata, Ryan Selka's hot take, the block. Always be aware of what you're reading and who's sponsoring it. Token fundamentals. Always make sure you understand like lending protocol incentives and what actually happens at the conclusion of the token mining, the liquidity mining events. You can actually clearly see downward pressure and reduced participation on all lending protocols that have any liquidity mining program. Bitcoin's spot price is converging with with the participants who acquire Bitcoin. Their profit and loss is converging with the spot price, such that the unrealized as well as realized profit and loss ratio are converging to smaller and smaller numbers, which could be a signal for a bottom. And last but not least, Ethereum developers are announcing the Shanghai upgrade, which will unlock all the stake ETH by March 2023. Wow, that's a lot of news for one day. If you guys want more details, you can see all of it in the show notes. Leave some feedback. If you hate it, leave some feedback. If you want more long form analysis, check out frontrunnercrypto.com. Hit the subscribe button. Otherwise, see y'all next time. Peace.